Welcome to Crash Concepts, where the economy, energy, and the environment are explored. Up next, fresh ideas and insights into the factors that are driving the world and shaping your future. Presenting information you can't afford to live without, here's Chris Martenson.
Well, welcome, Eric. It's a real pleasure to have you today.
Chris, good to be here, and thank you for all the work you're doing in apprising your investors of what's really going on in the world.
Oh, thank you. It's been at it many years, and unfortunately, much of what I think both you and I saw coming, and many others along the way, unfortunately not enough others along the way, is really coming to pass. If I could, let's start with your views. You've been advocating and creating investment vehicles for people to own gold and silver for a long time. How did you get to that position, and what are your views on owning gold and silver at this point?
Sure. Well, it all started, Chris, with sort of our studies back in 2000 that we're entering into a secular bear market, and how do you deal with that? And the typical response would be to own gold and silver, which is what we decided to do. I think the one thing that really tipped us into it was sort of an analysis of the physical supply and demand for gold, and some work by Frank Venerosa suggested that things would have to change dramatically in the physical gold market because the central banks are selling 400 to 500 tons a year. And as you know, here we are 11 years later, and now they're buying for 400 tons a year on balance. And this is in a market where the mines supply only 2,600 tons a year. So that's a huge change that had to take place that Frank kind of identified back then. He also identified that the gold companies would stop hedging. We've had ETFs come along. So we've had a lot of dramatic changes in the physical balance between supply and demand in gold. And that's really what kind of took us there in 2000 to get actively involved in that particular market.
And looking at it today, has anything changed in that analysis? So you mentioned a secular bear market. Are we still in one? And also, has anything changed in the fundamental supply-demand equation that's actually tipped it one way or the other, further or less, since the initial analysis you looked at?
Sure. Well, I do think we're still in the secular bear market, and basically what people use the phrase, extend and pretend, and we had the zero interest rate policy, the housing boom, the lending boom, TARP and TELF, and all those things which tried to delay what naturally should happen. When I look at the headwinds for gold and silver, I really believe that we've been aided and abetted by a lot of these policies, particularly QE1 and QE2, and the various printing mechanisms of the ECB and the Japanese government and almost all governments in the world. So much as I would not have anticipated those types of developments happening, they have happened, and they provide an even stronger headwind for people realizing that currencies are not going to survive, and that to maintain your purchasing power, you have to own precious metals.
I too have been surprised by how long all of this is stretched out. If you'd told me, hey, Chris, it was 5 years ago, Eric, if you'd said, Chris, the federal government in the U.S. is going to be running a $1.6 trillion deficit, and the Federal Reserve is going to be monetizing 75% of that, and the bond markets will be relatively tame, and the dollar will still, be roughly where it's at, I would have said you're nuts. But here we are, and my view on this is that what we're doing is actually we've kicked the can down the road. We bought some time. I'm thankful for the time personally. However, the risks are now increasing, and the risks that I've really identified that concern me a lot is that sooner or later, much is happening in Greece right now, where suddenly the world wakes up and says, hey, wait a minute, they can't possibly pay that back. And at 22% interest rates on 2-year paper, they really can't pay that back. So suddenly the illusion is lifted. We I guess collectively suddenly go, I guess Greece is insolvent. Oh, that's terrible, and now we're grappling with that. But that same dynamic can be extended to, I think, any of the governments you just mentioned. It varies across Europe somewhat, but Japan and the U.S., certainly there are fundamental mismatches between current productive economic output and the levels of indebtedness. We're printing our way to that. Is there a way that you can see that this could actually be turned around where it all sort of pencils out? Is there a solution to this that does not have to pass through a fiscal crisis and possibly a currency crisis?
Well, Chris, it's very hard to imagine that happening. And when I look at really what's happened over the last 11 years since we hit the high in NASDAQ, we basically created a problem in the world of banking business. And I always think of banks as being levered 20 to 1. And when your paper assets start to decline, of course, it doesn't take much of a decline to get rid of all the capital. And we've seen that in so many instances, whether it's Iceland or Ireland or now the Greek banks. And all the moves that have happened so far really have been in response to the problems in the banking system. That's why you had TARP and TELF and all those things, because the banks basically were losing deposits, and somebody had to come in and support them. So it happened in the UK, it happened in Iceland, happened in Ireland, happening in Greece as it's transpiring right now. And I think the big fear is that you can't let one banking system go down without an impact on all the other banking systems. So, collectively everyone's trying to support the banking system, and I think people see through the ruse, and the natural reaction is, well, why have your money at a bank when you earn nothing? Why not have it in something that might at least maintain its purchasing power?
Well, absolutely. So all kinds of productive assets spring to mind, and wealth preservation vehicles, gold and silver being obvious. But also we're seeing it, I think, some of that dynamic in the commodity complex in land prices, particularly for farmland, timberland. I think many people have come to the same conclusion, which is that there is something structurally flawed, both internally to the whole economic and fiat money model, and also externally, which is my metaphor for bringing in peak oil and the idea that we're really going to be facing an enormous headwind of rising energy prices, no matter how we slice it at this point, unless we discover something really magnificent. And so these are all upon us. And here we are. When you look forward into this, though, there's a big debate out there around, does this end up in an inflationary crunch, or do we go down a deflationary crunch? In my mind, I hold gold under both circumstances. What are your views?
Well, first of all, I can't agree with you more than I think three of the safest areas to be involved in are the precious metals, agriculture, and energy. Energy, unfortunately, might, if there's some kind of economic crisis, it could go down in the short term. But I think if you withdraw funding for the energy industry with the decline rates we have in oil and gas production, and people stop drilling, we would certainly see a very, very quick recovery. So I couldn't agree with you more. There is obviously doesn't seem to be any solution at hand to the problems, and I think people should stay focused on those particular areas.
And how would they do that in your mind? I know you've got a couple of funds that deal with these pieces. I know that I get questions all the time from people who are concerned about geopolitical risk, their jurisdictional risk, taxes. It's a very complicated environment, and I think increasingly complicated as governments struggle to maintain revenues and receipts and all of that. How do you suggest people begin to approach getting into these areas, many of which agriculture land, very, very difficult. Most people are stumped about how they would get into that particular area at all. What's your advice there?
Well, agriculture is the toughest because there aren't really that many public companies. I know that in Canada there's not much. I mean, for example, we have potash companies, which we've been active in, but there's not a lot of opportunity there that in the public domain. I guess in the private domain, people could own farmland, which you've already alluded to. But there's way more opportunities in precious metals and oil and gas, and I particularly emphasize precious metals because they're amongst the most liquid markets in the world. There's many, many vehicles available. Some have way better attributes than others. That's why we created funds where, if you buy our gold or silver trusts, you can actually receive the gold or silver. Of course, they can always buy coins, which they've been doing in great quantities here. So those would be my primary recommendations to people. Buy something where you can get access to physical metal.
Physical metal. And if you were going to, do you ever give out, I know this is a complicated topic, depends by age and economic bracket, other things, but do you have a range for a percent of somebody's portfolio that should be allocated to precious metals?
Hey, Chris, it's a favorite question I'm asked all the time. And I always respond in the way that what I do. And I know in our equity funds, we're probably 75% involved in precious metals, and probably 30% of that is physical metals, and the other 45 is in precious metals equities. In my own instance, I'm seriously involved in owning physical gold and silver, and I do always point out that I don't have any trouble going to sleep at night knowing that I own these metals, because there's no way that they're not going to hold their value in whichever environment you have, whether it's deflation or inflation, which you mentioned earlier. And I happen to be of the view that we will see deflation in paper assets, but we will see inflation in real assets.
Deflation in paper assets, inflation in real assets. One distinction. Do you include real estate in your description of real assets?
I don't include real estate, and the reason I don't include real estate is because it's basically a function of interest rates and the economy. You know, most real estate is backed by loans, and that creates a great problem. So I would certainly distinguish, as you have, that owning farmland, which is something that produces something real, is more important than owning, let's say, a commercial building that really is not producing anything but is backed by some mortgage, where ultimately the mortgage lender is going to have concern that his loan won't be repaid, and the price of that property would go down.
Yeah, I share that view. In this story, we get a lot of questions from people who are just sort of new to the game, and they look at gold at $1,500+. They look at silver right around 36 now. They look at the historical chart and they gasp and they say, "I can't buy now." How do you talk to people, or what's your advice around buying gold and silver now at these particular levels, or at any point in time? How would you advise people go about building a core position, say if they didn't have one?
Well, I think that the prices will continue higher. I mean, the amount of money printing is unbelievable. I just think you have to take that initial stand in terms of buying it. I kind of use the James Turk analogy. Just keep, dollar averaging. We've gone up 11 years in a row. This year looks like it will be no exception. I would certainly think next year will be no exception. If we ever had a quantitative easing 3 announced, I think gold and silver would just go absolutely bonkers here. And so I just think you got to step in there and own it. That we've had these fears all the way along, at $400 and $500 and $700 and $800 gold. Everyone was afraid it was a one-time thing. I don't think it's a one-time thing. I think it's a secular thing. It's going to carry on for quite a while here until we find some resolution of these problems. And the resolution probably will be some form of default, where people just have to expunge debts that can't be repaid. So you got to be in some asset which won't be affected by that.
I agree. I hear it a lot where people will say, well, gold's in a bubble, and they use price as the indicator to prove that. Bubbles are not indicated by price. To me, they're indicated by psychology. A bubble is a component of social psychology. Finance is sort of an afterthought. We put prices on it. I still can go to parties and find almost nobody who actually owns any physical gold themselves, or even people who own paper representations of gold. It's still a very tiny minority, I think, in the overall investing public at this point. What I do see a lot of are ads to buy all of your junk gold, as if there is such a thing. Yeah, I keep all my junk gold in a barrel out in the garage, waiting to haul it off to the local motel where they're holding a gold buying spree. I don't feel we're in a bubble yet because the psychology isn't there. The housing bubble had that psychology. We had hairdressers in Las Vegas with 19 homes. I don't know anybody who's a gold trader who's taken up gold trading at home, or has become a broker, or even owns any. What are your views here on gold being in a bubble? Sure.
Well, we've done some work on that, and we kind of looked at the amount of money that had been invested in gold from 2000 to 2010. And I think the weighting in gold went from 2% of people's portfolios to 0.8% of people's portfolios. But if you just look at the rise in the price of gold over that time period, it accounted for by far the majority of the increase in the total investment in gold and silver, which really means very few people were making new investments in the area. And I think that is still the case. Yes, we've had some early movers in gold. We had some of the hedge funds in the States buy gold. We recently had the Texas pension fund buy physical gold. But these are a few outliers here, and I don't think it's hit the mainstream to any extent whatsoever. And I might say in silver, I don't really see the institutional participation in silver. When we went out marketing our silver fund in October of 10, we had very, very weak response from the institutions, which sort of told me that, they haven't really taken the time to study silver and the supply and demand situation there. And I think that's all yet to come in both gold and silver, that it'll catch